This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
All right, number 11. A numbers one. What is the operational gearing of CQB? And if we look back, the following extracts from the statement of profit or loss of CQB and conventional, the sales income, cost of sales, profit before interest and tax, and so on, 60% of the cost of sales are variable costs. Now, two things here. First of all, remember, operational gearing is concerned with the level of fixed costs in a business because as the volume of sales goes up and down, the contribution, the profit before fixed costs will go up and down, but the fixed costs will stay constant. And so, what are the fixed costs here? 60% of cost of sales are variable, so the fixed costs are the other 40%, which is 20,000. Now, to be honest, the examiner here is being a little bit unfair because there is no standard measure of operational gearing. As you'll have seen in the notes, financial gearing, yes, there are two measures, but operational gearing there isn't. But looking at the choices here, the way we're going to have to do it, the way he would appear to have measured gearing here, has been the multiple of the sales as against the fixed costs. And so the sales here are 60,000. The fixed costs are 20, and therefore the operational gearing is 3 times. So I think a little bit unfair, but still. Number 12. What is the annual finance cost saving if the management reduces the collection period to 60 days? Well, you should immediately realise this is management of receivables question. And what does it say? It says the management of XYZ has annual credit sales of 20 million and accounts receivable of 4 million. Working capital is financed by an overdraft at 12% interest a year. Assume 365 days in a year. So although I think you can do this in more than one way, I think the way you should have learned, and the most obvious way, is simply to say, well, what are current receivables? According to the question, throughout the year we'll have an average receivables of 4 million. We're going to reduce the collection period so the new receivables, there's no mention of the sales themselves changing. So if it's going to be 60 days collection period, the receivables would be 60 over 365 times the sales for the year of 20 million. And so on average, receivables will fall to 3.28767 days. A million, rather. What am I talking about? Million. The fall, therefore, I said before, don't write every single thing down. I would keep the figure in my calculator. But if we subtract it from 4 million, I get a fall of 0.71233, whatever it comes to. Keep it in the calculator, but the interest will save as a result. It's at 12% a year. I get 85,479.452, which is yes, it is one of the choices. The answer is A. Number 13. Which of the following statements concerning financial management are correct? It's concerned with investment decisions. Yes. Shall we invest in a project? Financing decisions. How do we raise the money? Yes. And dividend decisions. Yes. So number 1, certainly true. Number 2, financial planning, financial control. Yes. Integral part of financial management. And number 3, the management of risk. Yes. You know, if you've been through the syllabus or chapter headings, all of those are dealt with. All 3 are correct. The answer, therefore, is D. Number 14. Using the geometric average historical dividend growth rate and the dividend growth model, what's the market price of a share to the nearest cent on an ex-dividend basis? Well, he's told you what to do. The dividend growth model, you've got the formula on the formula sheet that P0, the market value, is D0, the current dividend, times 1 plus G, the growth rate over RE, the investor's required return, minus G, the growth rate. Well, we know, do we not, the current dividend? The dividend for 2013 has just been paid, so the current dividend in cents is 36, times 1 plus the growth rate, which I'll come back to, over RE, strictly to shareholders' required return, but that is the same as the cost of equity, 0.12, minus the growth rate. So to complete it, obviously, we need to know what the growth rate is. And very standard, to work out the average growth rate when we give them the past dividends, as we are here, we say that 1 plus the growth rate to the power, however many years growth there have been. So how many years growth have we got here? Although with 4 dividends, in fact the growth, it grew from 2010 to 2011 is 1 year, 11 to 12 is 2 years, 12 to 13 is 3 years, so there's 3 years growth. So at an average rate of growth of G, total growth will be 1 plus G cubed. That's equal to the overall growth, the latest dividend divided by the earliest. So 1 plus G is the cubed root of that, which, since you must have a scientific calculator, you should have a button for it. Let's check I can get it right. 36 divided by 31.1. The cubed root comes to 1.0499799, well, effectively 1.05. G, therefore, is 0.05, or 5%. So now I go back to the main formula. Current dividend 36, 1 plus dividend growth rate 0.05 over 0.12 minus dividend growth rate 0.05, which is now a pure calculator exercise. 36 times 1.05 divided by 12 minus 0.07. I get 5.40. That's in cents. So it's $5.40. The answer is C. Uh, 15. To which risk does the above statement refer? The statement, there is a risk that the value of our foreign currency denominated assets and liabilities will change when we produce our accounts. Oh, it's clear what they're talking about. When we produced our statement of financial position, if we're in the US, if we're working in dollars, and we've got assets in Euroland valued in euros, well, they have to be converted. And year by year, as exchange rates change, the value when we convert to our currency starts to change. Well, that's called translation risk. The answer is A. It's a risk the financial manager, in fact, isn't generally too bothered about because it's only on paper. Economic risk is the risk of trading abroad in general, things like harder to collect irrecoverable debts, that sort of thing. Transaction risk is the risk we're really worried about for numbers in the exam, that you're receiving or paying foreign currency, but if it's not until next month or so on, the amount you receive or pay can change because of exchange rates. Interest rate risk, well, that's something to do with you, really. That's when you're borrowing or depositing money that interest rates may change. Anyway, the answer is A. Number 16. What is the length of the working capital cycle? So the working capital cycle, or the operating cycle, it's one of the very first chapters in the lecture notes. The following information has been calculated for A company. Receivables collection period, raw material inventory turnover period, work in progress inventory turnover period, trade payables payment period, finished goods inventory turnover period. Well, really this should be very, very easy indeed. We take the receivables collection period, 52 days. We add all the inventory turnover periods, so raw material inventory, we hold the cash is tied up for 42 days. The work in progress, it's tied up for another 30 days. The finished goods, it's tied up, cash is tied up for another 45 days. Then we sell it and it's tied up in receivables for 52 days. So cash is tied up for 2, 4, 9, 9, 12, 169 days. The only relief against it, we subtract the payables period. We won't lose the cash for all 169 because it's how many days? 66 days before we actually paid out the cash. And so the total working capital cycle, operating cycle, funding cycle is 103 days. The answer is what? A. You should find that a very easy one. Number 17. Which of the following is or are usually seen as benefits of financial intermediation? Financial intermediation, well, an intermediary is something like the bank. A bank, you deposit money, the bank lends it to other people. So instead of you lending direct, the bank's acting between the intermediary. Which of the following benefits? Number 1, interest rate fixing. No. That may or may not be a benefit of the bank, for example, but it's not anything to do with actual intermediation. Number 2, risk pooling. Yes. The bank lends your money to lots of people. Individually, those people are at risk. If you lend money directly, you're at risk because they may not pay. But because the bank's pooling the money, even if one of their borrowers doesn't pay, you are not suffering the risk. You're only at risk if the whole bank collapsed. Number 3, maturity transformation. Yes. You might deposit money with the bank for short periods, but there are always people depositing with the bank for short periods, so the bank's always got money. They can lend it out for long periods. That's what I mean, the maturity, the period of the deposit, the loan. They can borrow short and lend long term, sort of thing. So it's 2 and 3. Which one's that? C. 18. Yet another statement. 1. Which of the statements concerning working capital are correct? The twin objectives of working capital management are profitability and liquidity. Yes. We want liquidity. We want to make sure we have enough short-term money to pay our short-term liabilities. That's liquidity. But at the same time, we have to control it because from the lectures. Working capital isn't itself earning us money, so we don't have too much money tied up. That'll hit profits. 2, a conservative approach to working capital investment will increase profitability. No. Conservative, again, I can't go through the whole lecture, but you see, we need money for working capital. And where we get the money from, it can either be from long-term or it can be from short-term borrowings or a mixture. Conservative would involve holding actually more working capital than we actually think we need and borrowing it longer term to avoid any risk, which certainly won't increase profitability, it would reduce it. Number 3, it's a key factor in long-term. Yes, it's one of the fundamental jobs of financial manager. Decide how we raise money, decide what long-term investments we invest in, and decide our policy for working capital. So it's 1 and 3, B. 19. What's the current market value of each loan note to the nearest dollar? Let's read it. Lookco has 8% convertible loan notes in issue, which are redeemable in 5 years' time at their nominal value of 100 per loan note. Alternatively, each loan note could be converted after 5 years into 70 equity shares with a nominal value of $1 each. The equity shares are currently trading at $1.25. The share price is expected to grow at 4% a year. Before tax cost of debt is 10%, the after tax cost of debt is 7%. Well, this is really testing on 2 or 3 things. The market value of loan notes of bonds always is the present value of future expected receipts to the investor, discounted the investor's required return. And so let's just set it up before we see the second bit of the problem. The loan notes, the nominal value is 100. So on a nominal of 100, the expected receipts, first of all, they'll expect to get interest each year. The interest rate, where is it? They're 8%, so the coupon rate is 8%. They'll be expecting to receive $8 per annum. No tax effect. The investor will get the full interest. It'll be $8 a year for 5 years until redemption, repayment. In 5 years' time, they'll be redeemed, but here's our second problem. That in 5 years' time, they'll have the choice of either taking cash, first sentence of 100, or converting into 70 equity shares. Well, although they won't make that decision until 5 years from now, today's market value will depend on what decision they expect they'll make. And so I'll come back to that in a moment. But in 5 years, they have the choice of taking cash of 100, or they could take shares. And how much would the shares be worth? It'll be 70 shares. The current market value is $1.25 a share. But if it's growing at 4% per year, they'll expect the value to have gone up 5 years at 4% to that, which comes to 1.04 to the power 5, 2, 3, 4, 5 times $1.25 times 70. Converting, I think, will give them 106.46. There may be a little bit of rounding problem here. We'll see afterwards. But it's going to be their choice. And again, although they won't make the decision until 5 years from now, at the moment they'll be expecting, surely, that they'll convert, because that gives more than taking cash. And so what receipts are they expecting? Interest $8 a year, And then on conversion, 106.46. Not that they'll actually get cash, they'll get shares. But then, you know, if they don't want the shares, they could sell them and they'll expect to get 106. Well, there's their expected receipts. The market value always is present value discounted at the investor's required rate of return. And the investor's required rate of return will be the before tax cost of 10%. The cost to the company is the after-tax cost. The company will save tax, but it's investors' fixed market values. And what determines is the return that they want, which is the pre-tax cost. So now it's the first bit of discounting we've had in the whole exam. The $8 a year is an annuity. So the factor for 5 years at 10% is 3.791. I'll multiply in a minute. But the conversion, a single flame 5 years time, the factor is 0.621. And so let's do it. 8 times 3.791. This comes to 30.328. 106.46 times 0.621. 66.112. The total, 96.44 to 2 decimal places. What choices have we been given? And the question again. It says to the nearest dollar. Well, of course, to the nearest dollar, it is 96. The answer is B. So it's something you shouldn't find particularly hard, but that certainly takes a bit longer, clearly, because it is testing on several different things in the same question. Last of all, number 20. I mentioned earlier, always 1 or 2, but unlikely ever to be more on this sort of thing. More general economic idea. But which of the following targets relate predominantly to monetary policy? Governments have a number of economic targets as part of their monetary policy. Well, which of them? Number 1, increasing tax revenue. No, we call that fiscal policy. It's not monetary policy. 2, controlling the size of the growth in the size of the money supply. Well, that gives you the clue, which, yes, that is monetary policy, deciding how much money is in the economy. 3, reducing public expenditure. No. Again, that's fiscal. Fiscal is how much tax they collect and how the state spends it. 4, keeping interest rates low. Well, again, that's monetary policy, or what level of interest rates to have. So it's 2 and 4. The answer is C. And there we are for section A. The next one we'll carry on with section B.